Ring ring, hello, who's there? This is Chico at front desk. How may I help you? Oh, you need help with your call options trading? Well, this is your lucky day. You found the right channel. In this series of videos, I'm going to teach you my Tiger strategy, which can help you make money by selling call options. I've developed the strategies and tweaked it over many, many years. Now, why do I call it the Tiger strategy? Well, the term Tiger came from the use of by the US military back in the 40s and 50s, where they put together what they call a Tiger team to help solve some very complex problems. And this team was deemed high performance. And then later on in the 70s, NASA also used this term, and they used it for the Apollo mission in 1970, where a group of astronauts went up in space and the oxygen tank exploded, and they were kind of stuck there with this unexpected event. So NASA put together an elite Tiger team to be able to come up with ideas on how to bring them back safely to Earth, which they did. So my strategy is Tiger grade. Okay, before we delve into the strategy, let's talk a little bit about call options. Now in this video, I'm not going to go down into the nitty gritty and all the details, explain to you what options are or call options, but I do want to go over a few points. And let's first revisit what is a call option. A call option is a financial contract that gives you the buyer the right, but not the obligation, to buy a specific quantity of an underlying asset, such as a stock, at a predetermined price called the strike price, on or before a specific date, called the expiration date. In exchange for this right, the buyer pays a premium to the seller, also known as the writer of the option. In the Tiger strategy, we will demonstrate from the perspective of the seller. We'll sell call option contracts, and my goal is to make money mainly on the premium and to do it with a high rate of success. There are two ways of selling a call option. One is covered call and the other one is naked call. Covered call means you have the shares in hand already before you sell the contract. This way, if the buyer should exercise their right to buy the stocks and those shares from you at the strike price, you have it on hand, and so you can just sell it to him. Naked call is deemed higher risk, and the reason why is you don't have the shares on hand, and you have to go on the market to be able to buy it and then sell it to the buyer to fulfill your obligation if the buyer should exercise their right to purchase it from you. And so this might be very expensive for you because the stock could spike and then it will cost you a lot of money to be able to buy it. Also, the other thing you have to think about is, do you have the ability to trade naked call options with your account? Typically, it requires a higher level of approval to be able to trade naked call options with your brokerage account. Usually they call it level 4, and whereas covered calls is level 1, and level 1 usually is the level that you're already at when you do get approved for an option. Covered calls and naked calls are good for different scenarios. Covered calls could be good for if you already have the stock and you're just holding it and you decide you want to collect on the premium by selling some contracts, or you want to reduce the risk by already having owned the stock. Whereas naked calls, the advantage of it is like you don't have to worry about the downside of the stock. In this video, we'll just focus on covered calls. We'll perform covered calls in the demonstration. But at the end of each month, when we compute the results for that month, we will also tabulate the results if those transactions were for a naked call. This way you can see the difference in the results between covered calls and naked calls. On this whiteboard, I'm going to explain to you visually selling a call option and also the profit and loss zones associated with it. So let's say we decide to sell a contract to someone and it's for stock ABC. Today the stock price is at $48. Okay, the contract that we sold is with a strike price of $50, and the premium for this contract is $2. Thus, the buyer has to pay the seller $2 times 100, because for every contract there's 100 shares. So it gives the seller $200 in this case, and that's us. So we pocket the $200. Now, there are two scenarios. In the covered call scenario, we also have to consider the stock that we are holding. The most optimal zone where we're going to make money is between $48 and $50. In this zone, we have the premium from the sale of the contract, plus we get the appreciation of the stock that we're still holding. Above that, we have to sell the stock to the buyer at $50, and we miss out on the higher price that the stock is valued at, but we still have the premium, so we're still making money. Above $52 on paper, where we become to the point where we're losing money. And then below $48, here we have the premium, but the value of the stock has dropped, where we have to consider that. So on paper, we're net less than the premium, but still making money. The red zone, if the stock price continues to fall, we're in a loss for both the premium that we collected and the stock price.
One note on covered calls, just for clarity. For covered call plays, even if the price of the stock does go down after a call contract is sold to a buyer, and your original intentions were to hold the stock beyond the contract expiration date, regardless of selling the contract out or not, then you collect on the premium when the contract expires, and therefore this is financially better off than if you were to just own the stock without collecting on the premium, despite the stock going lower.
Combined together. Now in the naked call scenario, below $52, but above $50, we still have the premium, but we have to sell the stock to the buyer at $50. So we have to go out there, let's say it's $51, we have to pay $51 for the stock and then sell it to him at $50. So we have to deduct that loss from our premium. And so in the orange zone, we're still making money, but we don't make as much as the green zone, where we don't have to do anything. We don't have to sell the buyer any stock, and we just basically keep the premium, which is $200. Above $52, it becomes too expensive to buy the stock and sell it to him, where it's expensive in the sense that we're losing money now. The premium does not cover the amount of money that it takes us to acquire the stock and give it to him for what he pays us.
One key note on selling call options. Even if the stock price is out of the money, where the actual stock price is below the call option contract strike price, it is possible that you may get assigned by your brokerage to fulfill this contract. This is rare, but it could happen. This could happen anytime before the contract expires. In such a case, you made money from the premium paid by the buyer, and you need to then sell the stock to the buyer of the contract at the strike price. Here's a tip. If you don't want to have to deal with the possibility of selling any stock to the buyer due to the potential assignment of the call option just before expiration, you can buy the contract back before the market close on the day of expiration. This is especially important to consider for selling covered calls, where you may not want to actually sell the stock for long-term holding purposes.
Those are just a few points I want to cover about call options. If you need more information, you can go out there on the web and you can find more information about options in general and call options. All right, let's talk a little bit about the secret sauce, the Tiger strategy. We're not going to talk about the strategy completely here in one go. You'll have to learn about the strategy as we trade week to week and you follow me and I have more information to share. But overall, the goal is we want to find a stock that goes sideways. For naked call option, yeah, it can go down too, and you wouldn't have to worry about it. So as long as it doesn't go up in that case. And how do we go about this? Well, first, it's good to follow stocks and be familiar with them, their tendencies, characteristics, when it moves, how much it moves, and what is the view of the market for these stocks. Maybe you have your personal view, but can you get the view that the market's having for these stocks? Like, are they excited about the stock or not? And then you want to follow stocks that in sectors that you're familiar with or you've chosen to specialize in. For example, you're a software engineer, then you want to follow high-tech software stocks. Having more knowledge in this area may help you predict the trends of the stock. And then the other thing that's obvious is to trade stocks with higher market capitalization of larger companies. And the reason for this is because if there was some kind of surprising good news from that company where they discovered something new, then yes, their stock may go up on the market. But compared to a smaller stock with a smaller market capitalization, it's unlikely to go as high as the smaller stock, which could be very painful if you were to sell a call contract on such a stock. And then the other things that you can do is anticipate for events, and think about potentially how would these events impact the stock, or maybe you don't know and it's kind of like something that you don't want to touch until the event is completed. Such events would be like earnings date, or maybe there's a presidential race and election, and so you want to kind of figure out what could that do to the stock or the stock market. And then of course you listen to earnings calls or read the transcript if it's available. This way you can have an idea what management is saying and the questions that they're asked to get a better feel about where you think the future lies ahead for them. Again, when we go through the videos where I demonstrate this Tiger strategy through trading, you'll get more information about the strategy later. And I'll prove it to you that this is all you need to be able to predict trends of the stock and to be a successful call options trader. To disclose more of the Tiger strategy and to demonstrate it to you, I will do weekly trades. And the platform that I will use will be Schwab Thinkorswim platform. This platform happens to just check off all the boxes needed to perform this demonstration. And I will use simulated mode with what they call paper money. Paper money is fictitious funds, not real money. That way, every month, I can reset the funds easily back to a certain value. And then from there, we can easily calculate every month the performance of the Tiger strategy. Versus if I didn't do that, then it would all get lumped up from the previous month and it's kind of harder to dissect. So the value that I'll use for every month will be $40,000. I think $40,000 is a nice number where I can do at least 1 or 2 contracts per week, and we will trade weekly contracts. So there's enough activity for me to shoot a video and discuss matters on the strategy. Versus if there's too little money, then I only can do so many trades. And too much money, maybe that would be okay too, but let's try to do something as low as possible so it's more realistic for more people, I suppose, to prove a point, I suppose. And then, yeah, like I said, every month, just tune in for the summary and then we can see how good we're doing. And the next video, we're going to start the demonstration. We're going to get our hands dirty and start making some money. So don't miss it. And don't forget to like and subscribe.